This video builds on the previous one on price-to-earnings ratio, and it's part of a wider series examining how financial metrics actually behave in practice. Return on equity is one of the most admired numbers in finance. High ROE is often treated as a sign of excellence, a mark of quality, proof that a business knows how to use shareholders' capital well. And on the surface, that makes sense. If a company can generate a lot of profit from a small equity base, that feels impressive. It feels efficient, it feels disciplined, it feels like management knows what it's doing. This is why ROE is everywhere. It's stored early, it's easy to compare, and it gives investors a comforting sense of hierarchy. Higher ROE equals better businesses. Low ROE equals worse businesses. Simple. But this simplicity hides a problem, because ROE doesn't just reward good businesses, it also rewards financial behavior. And those two things are not the same. A company can improve its ROE without becoming more competitive, without becoming more productive, without becoming more resilient. In fact, ROE can rise even as risk quietly increases. That's what makes ROE dangerous. Not because it's wrong, but because it feels conclusive. It gives investors confidence at precisely the point where they should be asking questions instead. Before we critique ROE, we need to be clear about what it's actually measuring. Return on equity is meant to answer a very specific question. For every pound of shareholders' capital invested in the business, how much profit is being generated? At a conceptual level, that's a reasonable thing to ask. Shareholders provide capital, the business deploys it. ROE tells you how productive that capital appears to be. But the key word here is appears, because ROE doesn't just reflect business performance. It reflects how the business is financed. ROE is calculated as profit divided by equity. That means it responds to two moving parts. Profit can change, equity can change, and those two things do not move together. Most people focus on the numerator. They think ROE improves because profits rise. Sometimes that's true, but ROE can also improve because equity falls. And equity can fall for reasons that have nothing to do with the operating strength of the company. Equity is not a fixed anchor. It moves when shares are bought back, debt is introduced, assets are written down, accounting assumptions change. Each of these can push ROE higher without improving the underlying business. ROE is not a pure measure of profitability. It's a blended measure of profit and capital structure. That doesn't make it useless, but it does mean that when ROE rises, the most important question isn't how much better is the business. It's why did this number improve? Because the first mechanism that inflates ROE is also the most misunderstood: share buybacks. Share buybacks are often presented as a sign of confidence. Management believes the shares are undervalued, there is excess capital, so returning money to shareholders feels disciplined. And sometimes that's true. But buybacks have a mechanical effect that investors often overlook. They reduce equity. Nothing about the business necessarily improves. Sales don't rise, margins don't widen, competitive position doesn't strengthen, but ROE goes up. Why? Because the denominator has fallen. The same level of profit is now being measured against a smaller equity base. The ratio improves even if the business hasn't changed at all. This is why buybacks are such a powerful ROE lever. They make capital efficiently look better without making the business better. And when buybacks are funded by borrowing, the effect is even stronger. Equity falls, leverage rises, ROE jumps. The problem isn't that buybacks are always bad. The problem is that ROE doesn't tell you how the improvement happened. It doesn't tell you whether capital was genuinely excess. It doesn't tell you whether the business became more resilient. It just reports the outcome. This is where many investors get misled. They see rising ROE and assume rising quality, but sometimes what they are really seeing is shrinking equity. Because buybacks are only one way ROE can be flattered. The more dangerous mechanism is leverage. Leverage is where ROE becomes genuinely dangerous because leverage doesn't just flatter a ratio, it reshapes risk. To understand this, forget ROE for a moment and think about what leverage actually does. Leverage doesn't make a business competitive, it doesn't improve products, it doesn't strengthen demand. What it does is change who absorbs volatility. When the company introduces debt, it replaces equity with fixed obligations. Debt holders are promised a return, shareholders get whatever is left. That means equity becomes thinner, and thinner equity makes ROE look stronger. Imagine two identical businesses, same customers, same revenues, same operating profit. The only difference is how they are funded. One is funded entirely with equity, the other one uses a significant amount of debt. So the leveraged business will usually have a higher ROE, not because it's better run, but because profits are being measured against a smaller equity base. Even if total profits fall slightly due to interest costs, ROE can still rise. That's the leverage effect. This is why leverage feels like efficiency on paper, but it's really fragility disguised as performance. In good times, leverage flatters returns. Interest feels manageable, earnings are stable, ROE looks impressive. But leverage doesn't care about good times. It only reveals itself when conditions change. When earnings fall, interest doesn't. When margins compress, debt still demands payment. The same leverage that boosted ROE suddenly accelerates losses. ROE collapses faster than the business itself. And here is the key problem. ROE doesn't warn you when this transition is approaching. It looks best right before things break. This is why professionals are wary of persistently high ROE driven by leverage. They don't ask how high is the ROE, they ask how much debt is sitting underneath it. Because leverage doesn't operate in a vacuum, interest rates determine how forgiving leverage is, and that brings us to the next layer of the illusion. Leverage only looks benign under certain conditions, and the most important of those conditions is interest rates. When interest rates are low, debt feels forgiving, interest costs are manageable, coverage ratios look comfortable, cash flows absorb the burden without much strain. In that environment, leverage quietly flatters ROE. This is why many companies appear exceptionally efficient during long periods of low rates. Borrowing feels cheap, equity shrinks, ROE improves, and because nothing breaks immediately, it starts to feel permanent. But this is where ROE becomes misleading, because the ratio assumes the environment stays the same. It assumes interest remains manageable, it assumes refinancing remains available, it assumes stability in a nutshell. But markets don't guarantee any of that. When interest rates rise, the arithmetic changes. Interest costs increase, coverage ratios tighten, cash flows become constrained. Profits fall faster than equity, and ROE deteriorates rapidly. This is what makes rate changes so dangerous for highly leveraged businesses. The business itself may still be viable, but the financial structure becomes intolerant of error. ROE doesn't signal this transition in advance, it reflects it only after the damage is done. This is why professionals think about ROE in regimes, not just in isolation. High ROE in a low-rate world tells you very little about resilience in a normal rate world. Now we have seen the full picture. Buybacks shrink equity, leverage magnifies outcomes, interest rates determine how forgiving that leverage is. Which brings us to the final question. How do professionals actually use ROE? This is where ROE stops being a shortcut and starts being a clue. Professionals never read ROE in isolation, not because it's misleading by default, but because it's incomplete by design. At this point, it's worth mentioning one related metric: return on invested capital, also called ROIC. Professionals often look at ROIC alongside ROE because ROIC asks a different question, not how efficient equity looks, but how efficient the business really is. ROIC looks at profits relative to all the capital employed, both debt and equity. That makes it harder to inflate through leverage or buybacks. It doesn't make ROIC perfect though. but it does anchor profitability closer to operating reality. This is why a business can show a rising ROE whilst ROIC stagnates. The business hasn't improved, the financing has. That gap is where the truth lives. When a professional sees high ROE, the reaction isn't admiration, it's interrogation. They immediately ask, is this driven by operating strength or by shrinking equity or by leverage? And if it's leverage, how fragile is that structure? ROE is always read alongside other signals: debt levels, interest coverage, cash flow quality, performance across cycles. The ratio is not the answer, it's a prompt. This is why high ROE can mean very different things in different contexts. In some cases, it reflects genuine competitive advantage. In others, it simply reflects financial engineering. The number alone cannot tell you which one you're looking at, and this is the mistake many investors make. They treat ROE as a verdict. They see a high number and start thinking. Professionals do the opposite. They see a high number and start asking harder questions. ROE doesn't measure resilience, it doesn't measure durability. It measures a moment in time, and moments can be flattering. At this point, the broader pattern should now be clear. Price-to-earnings ratio compresses expectations into a number. ROE rewards leverage and shrinking equity. Free cash flow hides reinvestment and timing trade-offs. Each metric promises clarity, each delivers comfort, and each quietly relocates risk somewhere else. In the next video, we will take these ideas into cash flow. Free cash flow, often treated as the final truth. In reality, just another number that demands judgment. If this way of thinking resonates, skepticism over shortcuts and judgment over formulas, then this channel is probably for you. Subscribe if you want to keep building that lens, and I'll see you in the next video. All the best.